Hi there. I'm Jennifer Kennedy, the lead for quality at CHAP, and welcome to this month's CHAPcast. Today I'm talking with Kristopher Novak. He's the managing director with the Braff Group, and what we're going to talk about today is everything healthcare mergers and acquisitions. So welcome to the podcast, Chris. I'm glad to have you. And if you would, could you just share a little bit about yourself with our listeners?
Yeah, thank you, Jennifer. I really appreciate the time today with CHAP. So joined the Braff Group in August of this year as managing director, solely focused on home care. We kind of define home care as Medicare certified home health, hospice, the Medicaid, home and community-based services, private duty nursing, and also pediatric care. Prior to this, I spent 14 years with the Medicis, running their M&A department for the last 8 years. So great to stay with this segment of healthcare services. I think it's really important what we do out in the communities that we serve, given the aging population, giving where we are with Medicare Advantage. There's a lot of tailwinds despite some of the recent hurdles that we've all been working through post-pandemic. And it's great to be on with CHAP. I've got a long history with a lot of folks at CHAP. Given the Amedisys relationship, certainly Dan McPhillamy, but also Daniel Stevens and Nathan Decoding as well. And it's just great to be here. I should give a shout out to Teresa Harbor as well after all these years spending time together at various conferences. But, the one thing I really wanted folks to know about our relationship with CHAP goes back to my time with Dan at Amedisys. And one thing about M&A that's sort of one of the fun parts is naming the projects. And we had a lot of great names over the years like Centurion and Monarch and Foxtrot. Dan never got to name anything, and he was always quite jealous about it. So maybe Dan will have a project code name for the podcast when we wrap up.
I like that project code name. That's awesome. So, I'm a nurse, longtime nurse. I've worked in, home-based care in most of my 38 years of nursing, but you know that when we look at the current landscape of a home-based care, and it's not just home-based care, it's sort of like all healthcare, the whole healthcare continuum. We know that we have a huge influx of baby boomers that are going to be aging out, over the next decade, 2 decades. And that's really going to shoot the demand up for home-based care, particularly since we're seeing a push of home-based care and pushing that out of the hospital into the community. And, there's going to be a need to meet demand. And I think that's where the Braff Group comes in to assist providers in assessing, what do we do now? Can we handle things? What's the right strategic move to make? And I'm hoping that you can sort of give us a lay of the land of what at least home-based care and that environment looks like in that respect.
Yeah, you hit the nail on the head. I mean, I think just given where the aging population is going, where we're going around value-based care and the impact that we know we can make with patients and their families by taking care of them at home. We've got incremental technologies that are allowing us to do more and more at home. I mean, there's a lot out there around hospital at home recently. Certainly at our time at Amedisys investing in Contessa, but there's others out there as well that are trying to solve a lot of problems, and at the same time, we're staring in the face of, the nursing shortage and the labor issues that a lot of folks have been having. So I think the next few years are going to be very exciting. There'll be some challenges, but those challenges always provide great opportunities. And I'm just looking forward to seeing how different entrepreneurs, different operators, different private equity groups, and other investors tackle some of the bigger issues that we're going to have. We know that care based in the home is going to help solve a lot of those problems or just increasing demand. And it's a great time to be in the space, around the space. And part of our approach with the Braff Group is providing that consultative approach. Yes, we are mergers and acquisitions advisors. Yes, we focus solely on the sell side to help our clients achieve a great outcome. But really, in a best case scenario, we're working for 90 days to 180 days, sometimes more, in order to really dig into a business with an owner. with a executive team to understand how they can optimize growth, how they can optimize, the care they're providing and the quality outcomes. And look, we're certainly not experts in delivering that care, but we know the areas that are going to be important as buyers come to the table, work through a transaction, and what they're looking for. And so we think it's important to have that time to prepare and get ready to go.
So from my perspective, Chris, given what, your group does, the timing of when someone decides that they're going to be in the position to make an acquisition is anybody's guess. I from my perspective of compliance, quality, clinical, I'm seeing a few variables that can push that timing, like regulatory burden, for one, our move in the continuum towards value-based purchasing. I've worked with a lot of medium to smaller home-based care groups in my time. And I don't see that many of them are going to be able to make it, essentially, or from the acquisition side, there might be organizations poised to say, okay, well, we're looking to, expand or grow our organization. What are the timing pieces of all of this? When you look at assisting somebody to say, is it the right time to look to add to our org, or is it not the right time? What are sort of the chess pieces of that?
Yeah, sure. And there can be a lot of reasons and motivations for someone to say, hey, I think it's the right time to sell. And we hear a lot of different things in that regard. However, there's really three decision spheres that you want to try to overlap in order to maximize your outcome through that process. One is, where are you from a growth perspective? Two, what are your personal objectives? And three, what are the current market dynamics that are out there today? And so I'll kind of break down each individually. On the growth side, you prefer to sell kind of in a Goldilocks type spectrum, right? You don't want to sell when growth is too hot, and you also don't want to sell when growth is cold. And so you're really trying to find where you're in that market growth profile or a little bit above the market growth profile. If you're in that hyper growth scenario, you're just going to get less credit as it relates to purchase price. No buyer is going to assume that they're going to continue to grow in that hyper growth stage through their modeling period as they're thinking about applying value to your organization, because they're, of course, looking at the history of your organization, what you've done, but they're really looking at the go forward, modeling out sort of the next 5 years or so, and they're running all the financial analysis around discounted cash flows and getting to whatever metrics that are driving their investment decisions based on that. And so if you're growing, 15%, 20%, more than likely a buyer's not going to give you credit for that. And so you'd really rather wait a little while, achieve that growth. And we all know, the law of diminishing returns. It's hard to continue to grow at elevated rates when you think about continued market share capture. And so continue to capture that market share. And it may be 12 or 24 months down the road where then you are in that sort of warm growth profile, and you've achieved that growth, and you're going to get credit for that growth as it relates to your purchase price. And then certainly, look, if you prefer not to sell if you're below that market growth. However, there may be other stipulations that drive you to sell anyways. I think ultimately you're probably looking at a slightly discounted valuation based on the fact that a buyer is going to assume that there's some level of investment that they have to make in order to get back to that at least market growth potential.
You know what? As you're talking, I was thinking, how does all this impact access? So here, let me give you an example. You have organizations that might be acquiring smaller or medium organizations in rural care. I'm thinking rural home-based care, right? So let's say, a medium organization that provides that rural-based care is acquired by a larger organization. Does the access remain? Is it impacted? What happens there? And that's sort of a critical piece from my perspective as a nurse that I think about.
Sure. No, I think, look, I think buyers, particularly in our segment, right? Speaking to home care very specifically here, it's an important outreach into these rural communities. Sometimes, it's quite a bit to travel to get to some of the, facility based providers, and so, there are quite a few. Investors that are looking into those secondary, tertiary type rural markets. That's their strategy. They believe there's opportunity, from an optimization perspective, from a differentiation perspective on quality or otherwise. So there's definitely interest. I think no matter where an acquirer is buying in our space, I think what folks have to realize, because everybody's always concerned, what's going to happen to my people? What's going to happen to my job? What
Right.
about synergies is, sort of the term that gets thrown around a lot. What I think a lot of folks maybe don't understand is, look, our businesses are based on the great work that our clinicians do out in the field. And so it would be very short-sighted for a buyer in our segment to want to limit access, to be really cost controlled within the field. It's really, if there's cost control thoughts being gone on in the field, it's really more or less, how do we optimize the staff, and how can we grow market share in order to make the most of the clinicians that we currently employ, which ultimately will grow the business and be a successful investment thesis.
Yeah, that's good to hear. I think that might be a general concern when clinicians are looking at acquisitions. Is access going to decrease? And rural health is already hard to do. You know what I mean? And taking away an organization that provides that service, provides that touch, and the things that folks way out, and I've driven way out
Sure.
in my time, that they wouldn't lose it. I think that's important. But so thanks for sort of explaining that piece of it. Now, I've never been through sort of an acquisition when I was at an organization myself, but I've known friends that say, "Oh my gosh, this is painful," right? So I know that it takes there's lots of strategy and there's preparation that goes into it. Do you and your group try to set the pain level when you're going through the process?
We do. I think it comes understanding, probably what the expectation should be to work through the whole process. I think we always just implore folks, whether you're our clients or you're not our clients, is, look, there's a strategy that goes into this, and there is tactical preparation that needs to be completed in order to alleviate some of that pain. Look, every transaction comes down to price. It comes down to the terms of the deal, and it comes down to certainty of close. And so we spend our time with our clients on the front end, really advising them on the ways that they can prepare. I think you have to know your strategy to prepare for anything. A transaction is exactly the same. So a really good understanding of your strategy is important in order to set what those preparations need to be strategically. I think you have to have an understanding of what those personal objectives are, right? Are you doing this because you want to retire is a lot different than I'm doing this because I want to take some risk off the table, but I want to continue to run the business, and I need someone to, to come in as a financial sponsor and help me continue to invest in the business moving forward. There may be other family considerations, particularly if other family members are involved in the business, or it could just be a commitment to your staff, a commitment to the community and the legacy that you leave behind. I mean, there could be a variety of objectives. And once you really have a good understanding of your personal objectives, working with an advisor like Braff Group, what we can do is help you build that strategy, help you define what the process is going to look like, and give you an understanding and expectation for what the process is going to be. We're going to help you tell your story. Again, some of those, just in the objectives that I listed, which are just a handful of examples, could really warrant different stories to be told as you're preparing the materials to go market your organization. And then also, we're going to want to understand and make sure that we are getting the feedback and or commitments up front from buyers as they are presenting offers to you, so that you can understand, as you're vetting those offers, do they really meet my objectives, and that'll help you weed through who's the right partner. Who is it? Is it an outright sale? Is it a private equity group? Is it another investor? So that you can make a full decision. I think, when we think about selling your organization, it's likely one of, if not the most meaningful financial impact that you'll see in your life, and you'd prefer to do it once, and not have something stall out, and then have to go back to the drawing board and try again later. I liken it to, selling your house, selling, you more than likely will work with a real estate agent to do that. This is a much more complex business transaction than selling your house. I think something to the effect of like 90% of home sales are actually done through real estate agents, even with, for sale by owner and everything else. Most folks work with their financial advisor as they're planning out their future. We kind of wear a number of hats through the process, and it is in order to help, prepare and then also execute on that plan moving forward. And part of what we do on the front end is helping align with some of the other advisors that we highly recommend, that folks bring in early. I think, outside of the advisor that can help develop the plan, push through that process, which we'll talk about in a little bit more detail on the podcast, always recommend, that you really get some financial advisors that work through transactions on a day in and day out basis. We'd recommend that you do a compliance audit on the front end. Survey risk is a lot different than repayment risk. And that's, buyers are delving in more and more into due diligence. You need a tax advisor just so you understand structurally with the different deal structures that are out there, what it's going to mean for you and what your actual take home will be. And then healthcare transaction counsel. I'm sure a lot of folks have lawyers that they work with day in and day out, but this is a very specialized business transaction. We are a highly regulated industry. And so finding counsel that has experience not only on transactions but with healthcare will help you understand what's sort of market terms or normal terms as you work through the negotiation of about 100-page long document that becomes the definitive agreement and ultimately is that binding agreement, which leads to the sale of your organization. So just a few areas that we do that really lay the foundation. And for us, it's maximizing your ability to tell the story, to drive to the outcome and the objectives that you set forth at the beginning. But also, I can't stress enough that it provides you that visibility. No business is perfect. No buyer's expecting your business to be perfect. There's pros and cons. Having due diligence, successfully due diligenced over 50 deals at Amedisys, that means we probably, we're very serious and probably triple that amount of transactions that did not succeed for one reason or another. And that preparation allows you to understand the pros and cons. It allows you to defend some of the areas of weakness that you have. And it also allows you to elevate and highlight where you're very strong. And it gets you organized so that you can move through this process as quickly as you can, and so that it's less of a distraction, because the buyer is expecting you to operate your business through this time period, and they're going to want to get intermittent updates around your performance. And so there's a lot of reasons why we urge people very strongly to spend the time on the front end, to get prepared, to be thoughtful, and really it elevates your opportunity to get a really great outcome at the end of the day.
So, Chris, I know there's a lot of variables that would affect the timeline of when the process, how quickly the process would occur. But what would you say would be like an average of an organization going through that process?
Yeah, right on average is about 6 months. And that's a little bit of preparation. That's marketing your business to find out who's interested and what those offers look like. It's vetting those offers, picking a buyer at that point, probably providing them exclusivity. And then you get into, the very detailed due diligence process, which you're also going to be kind of in parallel negotiating the purchase agreement at that time, ultimately signing, and then working through whatever conditions to close, like regulatory approvals, delivering consents on payer contracts, leases, and ultimately a close and fund. So ultimately that's about 6 months. It may be a little bit shorter, and it certainly can stretch out if other things pop up in the midst of that process. And again, in this highly regulated business, we know that can occur. And sometimes you have to work through things within that diligence period that you didn't know on the front end and you couldn't have planned for. And so, it could take longer than 6 months. But on average for the Braff group, it's right at 181 days when we look at our data over the last several years, from ultimately making the decision, signing the engagement with us, and then getting to a close.
So you say things that pop up. Where, would you qualify those as the pitfalls during the process, from nose to tail, if you will, looking at a dog analogy?
Correct. Yes. And again, that's why we urge some of that preparation, right? So that you do know. I think, look, what we have seen in the last several years, and some of this I think is market driven. The market has been slowing down since 2021 at the peak of activity, at the peak of valuation. And so, buyers have a little bit of that buyer beware mentality, and, less deals are getting done. And so they're very much digging in, very, very, very deep. And so, I'd say two main pitfalls that we typically see are going to be, I mentioned survey risk versus repayment risk. And so the buyer is going to do the chart review. And that's why we urge folks to at least do a small random sample of, say, 30 charts. Maybe it's more if it's a large organization, just so you understand. And it's not around conditions necessarily of participation, but they're checking everything in those technical elements of the documentation, the eligibility, how does the coding look? They want to understand that you're meeting those conditions of payment, and they're sampling probably about 10% of your patients that are recent and have billed, and they're also going to sample some historical patients, most likely. And so they're really digging in, and they're not necessarily expecting a 0% error rate. We all know how complicated, the technical elements are across home health and hospice. We know that one nurse may, see continued decline differently in hospice than another nurse may see, or a medical director may see, or an auditor may see. But they're trying to get a sense of, how are you doing as it relates to all of those various pieces that do impact conditions of payment. And they're doing that because one of the main things that they're buying is your Medicare provider number. And so regardless of structure, stock deal versus asset deal, which we won't go into in the amount of time we have today, but they have all of that liability because they own that provider number. Medicare, if there is an audit, a SMRC audit, UPIC or something, they don't care who owned the business 2 years ago. They're going to the current owner of the Medicare number, and that's who they're seeking a repayment from. And so they can never rid themselves through the deal of that liability, potential liability, and that'll get into some of the negotiation on the definitive agreement, on the terms around what you are standing behind and how you limit that liability. But nonetheless, we see oftentimes folks have great quality, they've done great in their surveys over the years. They feel like they're doing wonderful, and what they don't realize is maybe they didn't update a form. The hospice election form had some changes in late 2020, and I can tell you from experience that we would be looking at a 2 or 3% eligibility error rate, and we'd be salivating as the buyer, and then someone would tell us, but they didn't update their form and there's 100% technical error rate. So if there is a UPIC that comes in, they would likely extrapolate. And then you're looking at a scenario where we can't structure protection significant enough to get us comfortable. And it's total oversight. It's not fraud or abuse. It's just oversight around updating that form. So that, I think that's where we saw the most pitfalls came in that clinical review. Certainly, there's financial pitfalls, and that's why we urge doing some diagnostics around your financials on the front end, because they're going to dig deep. And, if you're on cash-based accounting, switching over to accrual, the buyer's going to have some advantage as they look through your numbers and try to shift that advantage to themselves as they do talk about, we valued this on X amount of EBITDA or a revenue multiple, to try to put that in their favor. And so a couple of areas, there's a lot. Again, highly regulated business. Jennifer, you guys do a ton of work with folks
We do.
in these areas, and you know the complexity, and you know the areas that you can unintentionally run into issues.
Yeah, absolutely. I mean, it's a changing landscape, from not only year to year, it could be from months to months, depending on what's happening. All right. So I have one more question for you, Chris. What's the quality proposition, would you say, in what you do, how you help, this whole process of mergers and acquisitions?
Sure. I think what we bring to the table is the experience and the expertise, having worked through roughly 400 successful transactions in healthcare services. About 150 of those are in home health and hospice. I think, for us, most of our managing directors have prior experience as buyers in this segment as well. We take a very hyper focus, as I mentioned. So I'm not spread across a variety of services, healthcare services. I'm focused on home care. We live and breathe this 24/7. We participate with the trade associations, with a lot of other experts in our segment, because we want to drive great outcomes for our clients. What we've seen over the years is we've built about a 28% premium for the clients that have gone through this process with us. And I think that gets into not just living and breathing and immersing ourselves in each segment, but really it comes down to the data that we've collected over the last 25 years as a firm. We've got information on over 5,000 buyers. And so not only what are they interested in to match up the right parties for a transaction, how have people behaved? How have they acted through a deal? Helps us, as we look at offers and as we work through the process to understand, where their next move may be. But further to that point, we go through a very defined process that has been successful in that preparation, in that presentation, and also in really managing that whole process through that whole timeline to make sure that, a buyer is, behaving how they should through that process, but also being reasonable in their approach, whether that be what they're asking for or how they're leveraging that due diligence in the negotiation. And again, it's bringing to bear, 25 years as a firm, 15 years in the industry, the experience of what to expect. And every deal has its ups and downs. And I can't stress that enough, for expectations for folks as they get into this. And we've seen a lot of those things. And there's problem solving that occurs throughout the process, that will help get to a close in a fund, but also try to maximize that outcome with you as we work through that process.
Well, Chris, thanks so much for joining the podcast. You've given us a bunch of great information today. Any final thoughts?
Yeah, first I want to say thank you to Chap for hosting myself and the Braff group. Final thoughts. As I mentioned, it's a very complicated, very detailed process. If there's any questions related to some of the topics that we hit on today or others that we didn't have time to get to, we would love to connect. I'd say leaving thoughts is never forget as the seller, this is a two-way street. And there's some information that you'll want to gather throughout that process to help maximize your outcome too. And we'd love the opportunity to talk a little bit more about that and be support if a sale of your organization is something that you are considering.
Thanks, Chris, for being a partner with Chap. And thanks to all of you out there for taking time out of your day to plug into our podcast. From me and the entire Chap team, stay safe and well, and thanks for all you do.